You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose and the Loose. Happy Monday, July 28th. Man, it goes so fast. That's crazy. Today, I wanted to share with you my 5-minute framework to analyze any stock in my portfolio. I use those this super simple 5-step framework every single time. And one thing that I've discovered is when you are able to apply simple rules and simple framework, oh my God, life is so much easier. Less dilemmas, less doubts. You always invest with conviction. Never ask myself too many questions because all the questions I ask myself, they have been answered in those 5 steps. So here's how it works. So first thing is understand the business model. I cannot stress this enough. So many people, and this would be good also for ETF, would be understand the strategy, right? So many people, they just invest in something and they just recognize the brand or they heard about something and they stop right there. If you don't understand how people make money, how the business makes money, that doesn't make any sense that you start doing any research after that. Good example would be last week I discussed Dominion Lending Centers, right? And it's the largest mortgage brokerage network. So what they do is it's a middleman. So they connect borrowers with lenders. So they take a fee out of that connection. They do not have the mortgage on their balance sheet. They leave that to banks. And what they do, they just have mortgage brokers working for them. So they pay when they sell. So it's a very good business model where it's asset light across the board, and you only pay when someone closes a deal. So when there's a sale, so you pay when you make money. So when you understand the business model like this, and you can explain it in a very smooth way within seconds, now you have a full control, because then you will in a better position to go to step 2 and 3, which is craft the bull case and the bear case. So now we have understood the business model. We move on to craft the bull case. So how you can craft the bull case? Well, you need 3 things. And this is how we divide all our investment thesis now at Dividend Stocks Rock. We start with the playbook. So the playbook is kind of the summary of the business model. So how a business makes money, how it's is it recurring? Is it one-stop shop? What did he do to make money and grow and make revenue, basically. Then the second thing is having growth vectors, because it's one thing to have a business running, but then you want to see how it's going to be able to grow moving forward. Good example for that is for a long time, I had I could not understand how Dollarama could continue to grow their business. I saw, they're selling a lot of stuff. They're great $3 store in Canada, but I mean, it's limited to that country. But then they're still able to open new stores and they grow organically, and then they grow through stores in Dollar City. The growth in Central America. They want to grow in Mexico. They're growing also now. They look at growing by acquisition, such as the Reject Shop in Australia. So now they have found several growth vectors. So it makes a lot more sense. And finally, the competitive advantage or economic mode. So what is the best advantage versus other competitors? So it's important to understand if the product they're selling, let's say it's like a commodity, so it's open to competition, or they do benefit from good protection. My favorite example is Visa and MasterCard, because the more people use Visa and MasterCards, the more merchant accept those, and the more merchant accept those, well, the more people will use them, and they're making a fee. They're making money on the transaction, so that's kind of perfect, and they own the market with those two. So that's kind of best case scenario. So now you get all excited about the bull case. Now it's time to get back down to earth and write down the bear case. And the bear case is really important because now you force yourself to think about what could go wrong. What are the downside of that business? So the first item on this list is to list the business flaws. So business vulnerabilities, what could go wrong within the business? So what is great is you discover the flaws, but management has full control over them because it's part of the business. So it could be because the business is linked to commodity prices and now they're dependent on that. It could be because for example, Apple goes through innovation cycles products. So they are forced to invest in R&D to grow their business, be with new innovation. If they fail, well, that's going to be a problem. Then once you have the business flaws, I light up, you go into industry and market threats. So exterior threats, that could be like, oh, it's a cyclical market. It could be because for banks, for example, they're dependent on the Canadian economy. Things like that are out of their control. So if the economy fails, well, all the consumer discretionary will see their revenue going down for a while. That's just normal. They cannot do anything about that because it's the economy doing this. And then you have the competitive landscape. And what I love about the competitive landscape is, yes, you draw up like the big competitors out there, but it could also invite you to analyze more stocks and find even a better company in this industry, which is kind of interesting. So you have like the both sides say, oh, can they compete against this company? Or, oh, look at that. So for example, I did an analysis in 2016 in 2016 about Walmart, Target, and then I was looking at their main competitor online, which was Amazon, and I ended up buying Amazon stocks. Kind of crazy, right? Because based on that analysis, I realized that Amazon was way ahead in the online economy, where Walmart would probably finish a good, strong number 2, which is pretty much what's happening today, like almost 10 years later. So the business model, the bull case, the bear case. Now it's time to talk about dividend growth because that's one of my main focus. So I look at a trend like the latest dividend increase, the past 3 years, the past 5 years. So I want to see if the company is able to maintain the same dividend growth policy, if it fluctuates or if it's slowing down. If it's slowing down, big red flag. I have to investigate on this one. So very, very important. Then I look at the payout ratio. So same thing. I want to have like a dividend that increases on a stable way, like ideally like 5, 6, 7%, I'll be super happy. But then if the payout ratio is about the same, well, it tells me that the earnings is following. So super important. Once again, it tells me that the company will have enough room to continue their dividend growth policy. One thing I also like to do is to look at the dividend yield, the current yield, versus the average over the past 5 years. So if the yield is higher up right now, it tells me that the market is not buying the stock as much as it used to. So there's less demand, the stock price struggle a little bit, and then it's either like a good value play or it's also an invitation for investigation. So you need to figure out if it's a value play or if the market saw something and doesn't like it. So once I've covered the dividend growth health, I go to the last step and then that's just the mostly qualitative side, right? Then you have to look at the numbers. But for the qualitative side, that's how I work. So number 5, spotting red flags. So with the bear case, the dividend growth health, you should be able at this point to identify what is going wrong right now. So the first step is to look at the dividend triangle. So I look at the revenue trend over the past 5 years to see if there was big movements. Same thing with earnings per share and same things with dividend. So any big movement up or down, I'm going to go back into that quarter, read the press release to figure out what happened. Again, not too long ago, I did the analysis of Dominion Lending Centers, and I discovered that there was a big drop, a big loss in 2024. So in the earnings per share. So I wanted to know what was it about. It's because they bought back their preferred shares, and since the preferred shares price jumped, well, then it was recorded as a loss. But now that you understand that, they pay off just the debt. That's a good thing. So yes, it's recorded as a loss, but going forward, it's going to be a good move for them, and then the earnings per share is going to go back up. So then The investigation itself, it's all right. I get it. You can look at the long-term debt trend as well, because it's great to borrow money to grow and to invest. So capital-intensive businesses, but at one point, the business has to pay it back. So that is also important to have something that is stabilized and eventually going down a little bit, because it's great to have leverage, but you don't want to have too much leverage. Looking at anything that confuses you, that you don't get. If you don't understand something, you cannot find the answer, the best thing to do is probably to skip it. There are so many great companies out there. You don't need to buy something that you're confused about or you cannot explain. Always think back to that example that if you're not able to explain something to a 12-year-old about this business, that's because you don't have a solid grasp out of it and you're missing something. It's really important to dig deeper at this stage to really make sure that you have covered all angles and you invest with a high level of conviction. So if you want more trick like this, more framework, I have plenty of those in my Dividend newsletter. So you just go on moosemarkets.com and you can subscribe to the newsletter right there. So it's moosemarkets.com and you subscribe to the newsletter. All right, Moose, that's enough for today. Not tomorrow, but on Wednesday, we're going to take a look at Canadian National Railway and why it's not performing. All right, until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.